In this video, I talked to Magnus Larsson. Magnus is a director partner and portfolio manager at TimesSquare Capital, which manages the Steadyhand Global Small Cap Equity Fund. And Magnus leads that effort. He's the lead manager on that fund. Magnus takes us through what's gone well and what hasn't. And for sure, small companies around the world have not been an exception to the market declines we've seen, but Magnus tells us why he's so excited about the opportunities he sees today. Now, this conversation is part of a series we've done with TimesSquare Capital on the issues you've told us are on your mind, including technology, Asia emerging markets, as well as what's happening in Europe today. So we hope you enjoy not just this video, but some of the other videos that are part of the series.
Hey Magnus, how are you?
Hi Salman, I'm good. Thank you very much for asking. How are you?
Well, it looks like a hazy day out there in New York.
Yes, and sitting on the 42nd floor, it feels like you're up in the clouds.
Well, that's pretty cool, actually. Magnus, I thought we'd get right into it. It's been a difficult year for investors in general. Markets have trended down pretty steeply, been volatile, and while markets have gone down, global small companies have gone down just more than other stocks. So tell us about your mindset right now, given what you've experienced.
Yes, it has been a rough patch for all of us. And as often happens in market dislocations and sell-off, smaller companies does take a little bit bigger of a beating, partly due to liquidity. In this case, we have seen a slightly bigger effect than we've seen in other sell-offs historically, in that during COVID, we saw an influx of retail investors entering the market. Many of them had never seen a downturn before, and these investors are not always investing on the back of real fundamental valuations and fundamental work, but rather on bigger themes and sometimes even memes. So their reaction in this downturn has been to sell off a little bit more than we normally see, but in our opinion, that has led parts of the market to be very attractive on valuation.
Well, I love a good meme, but definitely not something that people should be using as their investment advice or investment analysis. Now, Magnus, something that you and I have talked a lot about is just this disconnect between company performance in terms of how its earnings are going and its growth potential versus its stock performance. So maybe take us through a holding as an example of how this is manifesting itself out there in the markets today.
Absolutely. Why don't we talk about Huhtamäki, a Finnish company and a global leader in sustainable packaging for the food industry, and increasingly also for fast food and grab-to-go market, as it's called. With their sustainable solutions in higher demand, it is possible to have your convenience and yet not compromising on the environment. We're looking at earnings for 2022 of increasing closer to 40% over 21, yet the stock is down 10%. Yes, that 10% is slightly better than the market as a whole, but that disconnect in our mind is just way too big, and we have added to the position as a result.
And Huhtamäki is just one example, and there's lots of these examples across the portfolio there that are doing really well on earnings, but perhaps not as well on their stock price. Let's talk a little bit further about some of the names in the portfolio, Magnus, and let's talk about maybe a stock that hasn't done as well. Maybe it just didn't deliver the way you expected it to, or maybe something fundamentally changed. Take us through an example of something like that.
Yes, let's talk Nippon Shinyaku, which is a Japanese so-called orphan drug company. Now, the share price didn't fare as well as it could, but it could have been worse. But really for us, the company did not deliver to what our process had projected. The management has not delivered. Their pipeline, while still there and interesting, we've seen delays in FDA approvals. We've seen question marks about some of the safety data. And when a company doesn't deliver to our standards, regardless of the share price, our process is to move on because we have so many other opportunities. So we decided to exit the position and move on.
Magnus, there's also been some changes in the portfolio. You tend to be a low turnover manager, meaning you don't buy or sell a lot of stocks over the course of a year. But there have been some changes recently. You've bought 5 new holdings in the third quarter of this year, and then there were 4 new holdings in the quarter before that. So tell us what's prompted this increase in activity.
So we can put it into two camps. One would be attractive valuation based on this very dislocation and sell-off that we've discussed. A good example would be WNS, originally an Indian company. More than 50% of their business would be in the US. They are a business process management outsourcing company. So they help companies, typically high volume traffic companies like insurance claims, travel agents, to scale up their operations either for seasonal events or a growing economy. But they also help companies to be more efficient with their processes heading into a downturn. And we see that right now that order intake is picking up as companies are readying themselves for a tough environment.
Now, I know you and I don't have a crystal ball, though we wish we both did. Maybe just to wrap up this discussion, let's talk about what investors should expect from the portfolio, given the type of philosophy you have and how you implement some of your decisions. So maybe, just in a few sentences, you can talk to what investors should expect from this strategy.
Absolutely, Salman. So yes, while we don't have a working crystal ball, we do have a process that helps us identify and invest in truly outstanding companies. Companies that have far above average profitability and return metrics. And that is more important than ever when you have higher inflation that wreaks havoc on the economy and for companies' input costs, whether it's wage inflation, energy inflation, other cost inflations. The ability to increase prices and pass that on is absolutely vital. And the portfolio is in very, very good shape for this environment.
Yeah, that's right. And we see something very consistent when we look at the portfolio aggregate statistics. This is a portfolio that where the holdings don't have a lot of debt. There's a low debt to equity ratio. There's high return on invested capital, meaning every dollar that these companies are putting into the portfolio is returning a large amount of return. And the companies seem to be having a lot of pricing power. And we've seen that in some of the earnings reports that we've seen come through. So we're ourselves quite confident at the future performance potential of this portfolio and why it continues to hold such a large place in the Founders Fund and the Builders Fund. Magnus, thank you very much for doing this.
Thank you so much for having me.